I mean, I had one guy who was he had pretty decent net worth, 5 or 6 million bucks, giving away giving away $5,000 a year. So that's not that big of a deal. But they had a big tax year. First time pushed up into the highest marginal rate. And I said, what if we did 10 years of gifting today? I mean, if you're confident you're going to keep gifting $5,000 a year, why don't we stack it up and put 50,000 in a donor advised fund, push them way up above the standard deduction, and it saved him, I think, 13, 14,000 bucks that year. Which I say this a lot, and I think it resonates, is that people value tax savings, a dollar of tax savings, so much more than they value a dollar of investment gains in the portfolio.
Welcome to Sterling Insights, Stand Out and Supercharge Your Assets, the go-to podcast for financial advisors aiming to grow their assets under management, stand out in a crowded market, and retain assets nearly forever. Are you advising high net worth clients who own appreciated capital assets? Do you want to help them sell without losing a quarter, a third, or even more of their hard-earned profits to capital gains taxes? Then this podcast is tailored for you. Each episode brings you the latest strategies and expert advice from leading financial advisors, seasoned attorneys, and experienced CPAs. Learn how to maximize your clients' wealth, minimize their taxes, and supercharge your advisory practice with actionable insights. Join us on Sterling Insights, Stand Out and Supercharge Your Assets, where you'll gain the knowledge and tools to set yourself apart and achieve unparalleled success in wealth management. Subscribe now and empower your practice for a brighter, more prosperous future. Welcome back to Sterling Insights. I am your host, Roger Silk. Our guest today is Matt Fitzsimmons. Matt is the managing partner at the Watchman Group and has spent over 25 years in the investment industry. He spent 17 years at True North Advisors, where he built the firm's investment platform and advised both institutional and high net worth individual clients. Today, he leads a firm focused on integrating tax strategy with investment management, and he helps families navigate complex planning across multiple generations. Matt, thank you so much for joining us.
Thanks for having me.
Let's start with what you're doing now at the Watchman Group. What's the backstory on that?
Sure, I did not. My partner founded the firm in 2004. Well, he purchased it actually through a practicing CPA who was also doing wealth management. And the guy was thinking of retiring, moving out of the business, and they were already kind of working together. So Mark actually took the firm over and acquired it from him, and that was the inception of the Watchman Group.
In 50,000 foot overview, what does the Watchman Group do? Who's it for?
Sure. We're a independent RIA. We're registered with the SEC. We're fiduciaries, and we offer wealth management services. But that's all kind of table stakes for firms like us. Really, who we are is that we have a strong background in tax. So while we offer all aspects of wealth management services, we definitely have an expertise in tax strategy. So that's often what we lead with. We're doing the investment management. I'm passionate about the investments and happy to talk more about that. But 4 out of 5 clients walking in the door are really curious about just how to optimize their tax strategy. So we're doing the tax strategy, we're doing the financial planning, which we're leading with that, and that informs how we build portfolios and manage investments. But again, it's that financial planning and tax strategy coupled with the investments, and of course, working with estate planners and CPAs to round out the full package of services for clients.
How would you describe or model the ideal client, the guy, the woman who you guys are built best to serve? Who is that person?
I always tell people we're looking for people who are delegators, who are willing to pay for advice, first of all. So the best clients want advice, they value advice, and they're just looking for experts to execute. As far as the demographic, I mean, it varies pretty widely, but there's a big component of professionals that typically are coming to us a little bit before retirement, in some cases after retirement, depending on the circumstances. But oftentimes the case is I'm looking to retire in a few years. And I would say, again, more people come to us who were do-it-yourselfers, but now see that we're in a bull market. The values of the accounts have grown. They're not as confident making investment decisions, and they're definitely not as confident when it comes to the planning decisions and when marginal tax brackets start changing. So, and we have entrepreneurs and business owners, that's a portion, professionals, and then some executives too. So, working through RSUs and pay packages for large public companies. So, it's kind of a mix of those.
And what kind of income or net worth brackets are you guys best geared up to help?
I mean, our stated minimum is $2 million of investable assets, but that's just you got to have a number on the door to start from. But, I'd say people with net worths of sort of $3 to $10 million, that's our bread and butter. Of course, we have several well above that, but, just by number and volume, those are the types of net worth levels that we're working with on a daily basis.
Uh-huh. So, and a typical, you can make one up. I don't use a real person, but somebody who comes to you, what's that person look like? What's that person looking for from you? How does that conversation go?
Like I said, it depends on how they come to us. Sometimes they've looked something up and found, we get good ratings as financial planners in the area. Other are referrals, so it differs a little by the source. Somebody that was doing it on their own and they came into a large amount of money through a liquidity event, and it more or less tripled, quadrupled their investment portfolio, and to a point where they asked their CPA, this is too much for us we don't want to handle this much, and they came to us. But it's easier to say what people don't ask for or what they're not saying, and they're not walking in the door looking for the next private credit fund or dissatisfied with investment results. Like I said, the most they talk about investments is it's too much for me, or I don't want to continue doing it. What they're asking for is more, hey, I had a life-changing event, or I'm retiring, or I'm retiring next year, and I make 500,000 a year. That's going to be cut in half. My tax bracket's going to change. I've heard there's some strategies. And the in the marketplace, I think people think that their CPA should be offering some of these tax strategies, but the reality is most CPAs are looking backwards. And so we fit this niche of tax planners that are forward looking and looking out what's going to happen the next 1, 2, 3 years and making decisions that benefit clients on a forward looking basis. And there's a whole host of strategies, and that's what people are asking for, and they're just not confident executing themselves.
Are you guys CPAs?
We have two CPAs on staff, and we have a guy who just got his enrolled agent license. So we have some firepower there.
So are you doing tax prep for clients? Is that part of your offering, or you're doing tax planning and somebody else is doing the prep and the compliance?
Yeah, it's the latter. So we're not signing tax returns, or, I mean, we'll help people figure out estimated payments, and we'll do some prep in that because not all CPAs do that. The meat of it is, if you look across the board, is that forward-looking tax planning, and just timing wise, our conversation is coming, like we're in the thick of it right now. Just because it's the end of the year and we've got a whole year to look back on, we know what income looked like, we know what the scenario looks like. This is where we can decide, are we doing charitable donations? Are we doing Roth conversions? Or what are the things we can do now that look smart, that are going to look good on the tax return when we get it next year?
So if you can, without disclosing any client material, give us maybe a couple of examples of some really kind of cool planning that you're doing for people right now.
Sure, sure. One that's pretty basic, but I find it still resonates, is just charitable planning and being thoughtful about how people are giving away their money. I think 3 out of 4 clients are pretty charitable, and they're writing checks to their church or to their local, whatever it may be. And while they have appreciated securities and word's getting out about donor advised funds, I'm still opening them. I'm not finding people are coming to us that already have them. And so the concept of that's pretty well known, but then there's just strategy you can do behind it. I mean, I had one guy he had pretty decent net worth, 5 or 6 million bucks, giving away $5,000 a year, but they had a big tax year. First time pushed up into the highest marginal rate. And I said, what if we did 10 years of gifting today? I mean, if you're confident you're going to keep gifting $5,000 a year, why don't we stack it up and put 50,000 in a donor advised fund, push him way up above the standard deduction. It saved him, I think, 14,000 bucks that year, which I say this a lot, and I think it resonates, is that, people value tax savings, a dollar of tax savings, so much more than they value a dollar of investment gains in the portfolio, because the portfolio is like seen as just this kind of thing. Sometimes it goes up a lot, but every once in a while it goes down. Try not to get too excited about it, but when you can offer someone a strategy that says, no, this year you're going to save $13,400 because we're going to do this, that really resonates with people.
What's some of the like really bigger kind of tax home runs that you guys have been able to pull off for clients?
Well, the first one that comes to mind, I haven't done it yet, but I'm committed to doing it. I'm going to find someone it fits. There's plenty of people out there it fits. I just have to meet them and get in front of but it's using a donor advised fund to fund a illiquid asset before the sale of the asset. So typically it's a business. So let's just say, and I have a few people that I've teed up to do this for. I had 3 guys that I actually did it for, or we were moving towards doing it. And it fell apart at the end because the structure of their business sale wouldn't allow for it. But the idea is if you have a company and you're a 10% giver, most people sell their company, they've built it their whole life, sell it for 25 million, and let's give 2.5 million to whatever charity because that's 10%. And they think of that and start doing that after they get the money. So after they've triggered the capital gain, many business owners might have no gain, and so they might have a negative basis. So huge capital gain is coming. Why not give away 2.5 million pre-tax? And there's a way to do that. You give away a slice of the illiquid private company, and so when the sale does happen, you avoid whatever it might be, so 20% or 20.3% of that amount that you funded, that 10%. So effectively, you're giving it away pre-tax, and then when it sells in your donor advised fund. There's no tax consequence on that piece. So there's 6 figures of tax savings right there. So I proposed it. I know how to do it. We walked all the way down the aisle with it and just didn't work. But I've got a couple people. It's just I'm waiting for the asset to sell to kind of fire that up.
Right. And then you guys are in position to manage those assets post sale.
Yeah, absolutely, absolutely. One other that's super interesting, I'll say quickly, that we're in the throes of research on right now, are just simply put a hedge fund type vehicle that kicks off ordinary losses. So where you invest 500,000 bucks into what from the outside looking in is just it's a hedge fund, but the way the hedge fund is structured allows it to kick off ordinary losses that, which would kind of be it's just unheard of. When I talk to CPAs about this, they're like, that can't happen. But there are some things out there that do that. And so if we could, couple some of the planning strategies like I just described with you're also a business owner with a 7-figure income. Here's a $500,000 deduction or a 6-figure deduction just for being invested in this vehicle. It would be very powerful. So we're in the middle of researching that right now.
Uh-huh. So that's not something that you've actually implemented yet.
No, not yet. There's a portion of it we have to accelerate capital losses. It's the firms that are doing these they're doing both. So we have implemented a form of our director of portfolio management has rebranded it to call it tax loss harvesting 2.0. And we are doing that. It's basically a way to accelerate capital losses by using long and short positions around a principal holding. And so you're implementing a market neutral strategy on top of it could be 2 ETFs, and then aggressively harvesting the losses out of the market neutral component and accelerating that. That would be more, I'm going to offset a future capital gain.
Right. Right. Okay. And so many of these, it sounds like these would be more applicable for the higher end clients, the business owners, the entrepreneurs.
True. Yeah. The minimums are a little higher. It's not something you would implement across the board, The hedge fund has higher minimums. The second thing I described is a little bit lower, but it's not something that's for everybody. You've opened up a brokerage account to run a hedge fund strategy, and people aren't used to that.
Right. And are you guys running that yourselves, or is that an outside provider who's doing that for you?
Oh, it's an outside manager. So yeah, they run that market neutral component. It's just it's that's a separately managed account effectively.
Oh, okay, I see. And so that sort of is a good segue to your guys' approach to the investment portfolio itself. How do you guys think about that? How do you tend to think about it?
Yeah, you're just talking about portfolio construction in general.
I suppose, right, because if somebody's having a separately managed account, I would presume that the investment strategy is more important than the tax part of it.
Well, that one's a little bit of an exception because it's just its uniqueness, because we can control the investment, and you could think of the market neutral as market neutral expectations. It's not going to add a ton of economic value by itself. We wouldn't be recommending market neutral strategies if that's all it was. I'm not doing those in IRAs. We're doing it for, okay, we'll get a little bit of that market neutral return, but we're really going to get the tax alpha. But just from a portfolio management standpoint, I guess just going back to how we build portfolios, we don't typically use separately managed accounts. I have in my career extensively. I mean, 20 years ago, we used them all the time. But we do a lot of the security selection, not all of it, but we do some things in-house. And so we're not allocating as much just in the last 5, 10 years to really active separate managers or mutual funds. I mean, we have a few active funds in the portfolio, but there's more either the really active stuff we're doing, either via ETFs or individual securities. And then we're buying passive exposure, semi-passive exposure to build out the diversification.
So this just to continue that, suppose you've got somebody and they've got a couple $1 million of investable assets with you, and you're looking at that. How you're starting with asset allocation. How do you look at
We're
it?
starting with the financial plan. So just putting framing it as we want to figure out what your goals are, your goals and objectives, and build a financial plan and let that kind of drive the risk, the portfolio. Once we know the general direction we want to go from a risk and return and what fulfills a successful financial plan, then we're making asset allocation decisions basically, and then implementing our own views. And in the last 5 or 10 years, it's been almost entirely traditional assets. And only recently have we added some alternative exposure. I think there's reason to look there more today relative to just where traditional assets are priced and maybe what the opportunities are.
So by traditional, I kind of hearing stocks and bonds.
Yep. We,
Uh-huh. And
we've we've been heavy proponents of U.S. equities for the last 7, 8 years, even beyond. And it's been great. I mean, people weren't asking for, again, private credit or alternatives. If, we have a strategy that, that fits and fulfills the financial plan. And I'd like to say we've given people the confidence to invest in stocks. And we've been in this great bull market, going back, I think I looked the other day, I've been showing clients this chart that goes back to early teens, maybe 2012 or somewhere in that time frame. The S&P's done 14% a year and bonds have done 2% a year. So just through that lens, with hindsight, obviously overweighting equities, even tactically, was the right decision. Now bonds were yielding the 10-year was at sub 2% and earnings yields were at 7%. And that's kind of changed. So now you've got, and another way to say that is stocks have gotten a lot more expensive and bonds are yielding more. So the relative value is better for bonds today, but it's also worse for stocks. So what does that mean? Just one way to think about, okay, maybe we start looking elsewhere to find that 14% a year return.
so what kind of alternatives are you guys looking at these days?
We're pretty selective, and the process on the alternative side has been opportunistic. We don't have a program of many years ago. I built programs where we were 20%, we were going to fulfill it this way, and we want X in private equity and so on and so forth. It's a little more fluid and opportunistic than that. So today, there's a real estate opportunity that we like and we've been using and talking about. It's in the multifamily sector. It seems like that's one area of the world where you went through a downturn. So in 2022, rates rose a lot quickly. And, if you were out there taking on debt and buying real estate before that, especially right before that, you've had an adjustment. And if you were levered too much, you didn't have things structured correctly, there are some problems there because that happened. And so there's some opportunities to buy things, we've seen 20, 30% off of where they were, 4 years ago. It's just, real estate is always a local market and there's no big board telling everybody every day what the prices are.
What kind of real estate are you looking at?
Multifamily.
Uh-huh. And
So
what kind
the,
they're in
the the strategy
Texas?
we're using, sorry,
In Texas or someplace else?
it's the fund that we're using is target Texas, Florida, Carolinas, and Arizona. So obviously business friendly states with good demographics, positive inflows.
And what
So
sort of
I was going to say we've had a housing theme in our own portfolios for, gosh, going back to 2018. And I view this as just an extension of that. So, we own some direct housing stocks, we own some picks and shovels, we own manufactured housing. This is all in the public markets, but so multifamily, and I think the catalyst was this rate hike that happened in 2022 that changed the pricing out there. So if you're with somebody that knows what they're doing, there's people that are having to turn over the keys to their multifamily properties and lose all their equity because it was just wiped out in the last 3 years.
so what kind of cap rates are you seeing in multifamily?
I just saw one at 6. I thought that was pretty good.
Uh-huh.
So that was a little higher, but they've been at 5 or in the 5 range, I think. This is a strategy that's a value add. It's not a core, buy and roll rent. So there's that component too. That again, with a group that I think has executed well in the past, and the timing is right, I think, for its capital to go in because I think prices are down
So the concept here is buy the units, fix them up, and get rent increases that way to get a positive carry.
effectively. Yep.
Because at the current at six cap, can they finance it positive or are they gonna have a negative carry at six cap?
Yeah, no, I've seen them be able to finance it. I don't know the rates off the top of my head for each property, but there was one deal we looked at that, the guy across the table lost his equity and they went to the bank and asked the bank, basically, we don't think it's worth what he owes. So the bank renegotiated, the bank took a little hit. So that's why I'm curious why people aren't talking about it because it seems like in the public markets, it's kind of hard to find a place where you could say there's real distress here. Maybe there's some opportunity. It's kind of the opposite. There's a few places in the public markets where you might make that, but I was in an alternatives conference recently and nobody talked about real estate. It was all about private credit, infrastructure, and some other things. And I asked a guy across the table from me about real estate. He worked for a much larger RIA, targeting clients ultra high net worth. And I said, "Why? What do you think?" And he said, "Well, our clients already had real estate and they have losses, and they're not interested in more right now." And I said, "That's exactly why I'm interested in it.
Right.
That's that's kind of what we're buying into." So, I mean, I think people would say, okay, prices were elevated 3, 4 years ago, well, and we're buying 30% below that. So that's pretty good cushion from elevated prices, in my opinion.
Yeah, sure. Matt, we're kind of running out of time here. I know we've talked about a few things, but what are some things or one or two things that we have not had a chance to talk about that you'd like the audience to know about you guys or about what you do?
Sure. I think there's an interesting dynamic just happening. I started in the 90s working for an RIA. So back then that was very unique. When we talked about being a fiduciary, that was a big selling point. Independent, all those things. And we sold pretty hard against wirehouses and the just the nature of that and that there were different strategies. Your broker didn't matter, that they could do different things. And what I see today, what's really interesting just about our industry is we've kind of come full circle. So what I'm referring to is the massive consolidation boom that's been occurring the last 5 or 10 years. I have friends that are at firms 10 times our size that are getting bought up by firms 10 times their size. And I look around and it's just like everybody's selling. And I get it. There's logical reasons. As a firm grows, it's hard to sell to the second generation. What I would say is we've kind of come full circle. There's these really big firms that yeah, it's not Merrill Lynch or UBS, but that it's kind of where everybody's ending up. And one of the things I would say to toot our own horn is I think that's a differentiator for us to say, look, we're 100% employee owned. My partner and I every day make decisions in the best interest of our clients and our employees. Those are our constituents. And, there's no competing, there's no private equity fund in the background with a 10-year life with two 1-year extensions that needs liquidity and is expecting you to hit growth rates. I have a friend that the one I just referenced, he's at a big firm and he sold and I hadn't caught up with him. And he was telling me about the transaction and all this stuff. And he just said, Matt, I work for a sales firm now. That's what I've got. We've got to hit these numbers because that's the nature of the beast. I just think it's an interesting dynamic in our industry. It's not a knock on those firms, and it doesn't mean I would never look at a strategic partner, but just where we are today, I think that's somewhat of an advantage if I get to sit in front of someone and tell them our story about tax planning and independence, because it changes those transactions. They change the nature of that company. Hopefully it's for the better for them, but it does change things.
Yeah. Matt, where can people go to learn more about you or the Watchman Group?
Our website is watchmangroup.com. That would be the place.
Okay. And just like it sounds, what?
Yep. WATCHMAN group.
Yeah. WATCHMAN group.com. And that's all one word, right?
That's right. That's right. I think I left out a letter. I went too fast.
Okay. All right. Matt, thank you so much for joining us.
Yeah, I really enjoyed it. Thank you, Roger. Appreciate it.
Yep. Thank you.
Thank you for listening to another episode of Sterling Insights. Stand out and supercharge your assets, where we provide the info you need from successful leading financial advisors, lawyers, and CPAs. Your hosts, Roger and Catherine Silk, invite you to learn more about Sterling Foundation Management by visiting sterlingfoundations.com.